In this week's episode of Sneaky Things That Mortgage Lenders Do, Part 2, we're going to talk about the difference between hard inquiries and soft inquiries, okay? Maybe you've heard of this term trigger lead, maybe you haven't. For me to explain where things get sneaky, I need to explain the difference between credit inquiries, the hard and the soft, and then what these trigger leads are. So let's start with a soft inquiry. It's generally one credit bureau that's being pulled, so we're only getting one score. It's not a hard inquiry, okay? So it's not negatively affecting your credit report. On the other hand, the hard inquiry is pulling all three credit bureaus, and it is a hard inquiry, so your score may go down a couple points when we use it. Finally, what's a trigger lead? Well, a trigger lead is when we pull a hard inquiry, the credit bureaus, Equifax, TransUnion, and Experian are all selling your information to a bunch of other mortgage lenders out there that buy these trigger leads because they know that you're doing a mortgage, right? So that's kind of their cue, like, ooh, well, let's jump in and try to earn the business, okay? Where things get a little sneaky here is mortgage lenders have now started exclusively using soft inquiries when they're doing pre-approvals because they want to avoid those trigger leads. Maybe they say they're doing it to your benefit so that you don't get a bunch of phone calls and a bunch of text messages. I think maybe they're doing it because they don't want to deal with competition at the end of the day. Maybe their rates are a little higher. But here's where things get a little sneaky. If we're not doing a hard inquiry for you, and if we're doing a soft one and we're only getting one credit score, what happens if that credit score that you get, that we get pulled, is a 720? Okay? And a mortgage lender now is going to figure out what your interest rate is based on that 720 credit score. By the time you go under contract, they repull a hard inquiry now because that's what's required to go through underwriting and get a full approval. What if at that point they pull all three scores and it's a 720 on the high, 689 in the middle, and a 679 at the bottom? Us mortgage lenders are required to throw out the high score and the low score and only go with the middle score. So now you only qualified a 689 credit score. And if previously it was a 720, that could be the difference of up to 0.5% in interest rate, $3,000, $4,000, $5,000 in extra costs. A big change for you. The question you need to be asking your mortgage lender at the end of the day is, are you doing a soft inquiry or are you doing a hard inquiry? What is that going to do to affect my interest rate? Where it becomes sneaky is mortgage lenders are doing it to avoid competition, but you as the consumer are not getting the full picture of what you could qualify for. So ask good questions. Be curious.